Kia ora, and welcome to the CoreLogic Property Market Update for Here Turi Koka, August 2023. The turning point for the property market looks to have arrived, although it should be noted any recovery is unlikely to be uniform and certainly not strong in the near term. Nonetheless, according to the latest CoreLogic House Price Index, we have started to see value growth in some key markets emerge. These areas include Papakura, Manukau and North Shore in Tamaki Makaurau, Auckland, alongside Porirua, Te Awakairangi ki Uta, Upper Hutt, and Te Whanganui Atara, Wellington City. In fact, the wider Wellington market recorded its first monthly increase in property values since February 2022. Wellington has been one of the weakest parts of the country over the past 1 to 2 years, so it's unsurprising to see it bottom out first. Despite a relatively quiet July, where sales volumes fell 2% year on year, transactions are still up 8% over the past 3 months. The blip in July could provide insight into the inconsistencies that will likely be present as the market finds the floor. If sales activity has now turned the corner, it adds to the strong sense that more markets will join Wellington in seeing house price falls come to an end in the next few months. While sales volumes are rising, it is from a 40-year low base. But even so, the pickup in sales activity in recent months, combined with a continued lack of new listings coming onto the market, is eating into stock levels. This could prompt more competitive price bidding amongst buyers. Looking more closely at listings, the past 4 weeks have only seen about 5,200 new properties brought to market across New Zealand, around 31% lower than the norm over the previous 4 years. And the number of properties on the market is 15% lower than it was a year ago. There are other factors that suggest an imminent end to the downturn in prices. First is interest rates. While rates have been tweaked higher by many banks lately, it's still widely expected that a broad peak is here. This means households can quantify their financial worst case, and some will be able to start making affirmative property decisions again. Second is net migration, which remains very high at almost 87,000 in the year to June. There has been a rise in people leaving New Zealand for other countries, especially Australia, but for now this outflow is being swamped by waves of new arrivals. And the key point is they all have to live somewhere. At a rate of 3 people per house, that's an extra 29,000 dwellings required. At a rate of 2.5 people per house, requirements would jump to almost 35,000. We suspect that a lot of this migration will show up in the rental sector, at least for a start. And in fact, there are already signs that rents are accelerating. Stats New Zealand reported a 4.1% rise in the year to July, the fastest pace of growth since June last year. Other supporting factors for housing include a still strong labour market, with only a small rise in the unemployment rate from 3.4% in Q1 to 3.6% in Q2, and the easing in loan-to-value ratio rules. Looser LVRs haven't yet been an outright game changer, but no doubt some first home buyers will have taken advantage. And it's certainly true that investors with between a 35 to 40% deposit, who were previously locked out, have now started to re-enter the market again, or at least take out top-ups on properties in their existing portfolio. Meanwhile, the Reserve Bank has just released their latest monetary policy statement, with the official cash rate held at 5.5%. No surprises there. They basically didn't change their forward projections for the economy, employment or inflation. And while they also think the housing downturn is finished, the upturn won't be rapid. On Reserve Bank forecasts, house prices in late 2026 could still be lower than the 2021 peak. To be fair, a further small rise in the official cash rate can't be ruled out altogether later in 2023. But the Reserve Bank's modest upward tweak to their cash rate projection seems to reflect a modelling technicality rather than a clear belief that the OCR actually needs to rise again. So the bank remains in wait and see mode, and for mortgage holders, this supports the belief that interest rates have peaked. But equally, we've still got serious inflation concerns, so we don't expect falling mortgage rates anytime soon either. Overall, the past month has brought more evidence of a turning point for the housing market, but it remains patchy and inconsistent. For every region or area that saw a rise in prices in July, another saw continued drops. The indicators are there, however, for the falls to become less common in the next few months. With the election looming, property investors are no doubt watching very closely. Some simple numbers suggest that it is actually the large negative gap between rental yields and mortgage rates that is driving chunky cash top-ups for would-be new property investors, rather than the absence of mortgage interest deductions. So we're not completely convinced that the potential reinstatement of deductibility would suddenly bring back a flood of property investors, but no doubt some would trickle back. To stay across the latest property market data and insights, make sure you follow all our news updates on the CoreLogic NZ social channels, including LinkedIn, Instagram, Twitter or Facebook. And download our latest monthly chart pack and subscribe to the New Zealand Property Market Podcast on all good podcast players. Mā te wā.